Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today, we're going to look at some different things with total bank credit GDP in relationship to inflation, and then in relationship to what I consider to be the greatest inflation hedge or the thing that is causing the inflation, oil. If you guys need help with any ideas around how to play this commodity bull market, join our community. We've got finding-value.com. Join the Platinum membership. You can use the word discount in the coupon code to get a discount, and obviously get a bigger discount with the yearly membership versus the monthly membership. A reminder, 7 a.m. Mountain Standard Time, Saturday, Platinum members question and answer session. I tape it, I put it on the website, and you guys can view it if you can't make it. Either way. Let's dive into some of the data that I pulled up. This is basically what I look at. Sometimes I try seeing what data is out there, and I'll kind of go into why I chose this a little bit. Total bank credit is basically money coming into the system. That is total bank credit. Banks create money in a fractional reserve lending system. So what we've seen in the past, so if we were to look in the past and go way back, and I'm going to try to show you with a little bit of data here, this goes back to the 1970s. It's inflation is more or less an imbalance of credit in the system in relationship to goods and services. So when you see these inflationary periods, you see an imbalance between credit and GDP. And it doesn't mean that if we go sideways that we get this imbalance. It's the difference when GDP doesn't keep up with that credit growth. And what we see here is we go from one level to another level to another level, and I'll show that over time. So if someone were to say, what type of period do stocks do well in? It's a period that doesn't move higher. The inflation is relatively low and we're stable, where the GDP versus the credit growth are very similar. That's a low inflationary environment. When the credit growth exceeds GDP, it means more money is chasing fewer goods, or more credit is chasing fewer goods and services in the system. That is, by definition, inflation of the credit or inflation of the money supply. Money is credit, credit is money. So what this is we're basically looking at the business cycle or real estate cycle. Those are the two same things when I say that. Business cycle, real estate cycle, same thing. Now, a lot of people, what they do is they get confused on where we are in the credit cycle. So I'm going to go in, I'm going to try to explain things that I think are happening. It's only from my financial opinion and how I am reading the data and how I'm interpreting the data. So let's dive in together, and I can tell you kind of what I'm seeing. So I've got three charts up here. Again, total bank credit divided by GDP is this white line. And you can see a couple of distinct things in this chart. If we were to break it down, we've got a period where it kind of went sideways a long time. We broke that period, came up to another higher level. We consolidated at another higher level, and then we broke that. And I think that we're doing a retest move in technical analysis. What we have is we go from one level, and then you usually get a back test or a retest. It's basically people where they break into a new level, they make money, they sell off, they sell their stock to take profits, and it basically comes back to that breakout point. So that happens very much in technical analysis. So we have three distinct periods. Now, if you look back here, and I don't have any data before this, it was way lower back here. We came into a much more elevated level back in the 1970s, where we had more credit growth, but we also had good GDP growth back then as well. And remember, it's money floating around in the system. This doesn't tell us if the money or money velocity in the system is necessarily kicking up. So we can have total bank credit versus GDP, but you can also have money velocity kick up as well. But anyway, we went into a environment where total bank credit was outpacing GDP. Think of that as liquidity in the system chasing fewer and fewer things. If you notice, you can look down here, and what we've got is this is the inflation rate. the inflation rate going up and down, and then you've got the oil price on the bottom here in the teal color. If you look at where the breakout is and basically where we stopped breaking out, that is our growth of the oil price. So when bank credit puts GDP into an inflationary timing where total bank credit exceeds GDP and it exceeds it at ever greater quantities, that is going to put pressure on oil, and oil prices rise because you have a shortage of oil when you have more money chasing fewer goods. You can also see that the inflation rate in 2001 went from a pretty low level to a pretty high level. Basically, I drew this line here where the inflation rate kind of hit its head on a level here a couple of times. So we hit our head on it and then we came back down and we went into a disinflationary environment. What that means is that your GDP starts to outperform total bank credit and it goes back down. So either you've got two things. You've got either bank credit being destroyed, bank credit growing very slow, or GDP growing rapidly, or a combination of those things. So in this period here, when we're sitting and going sideways, that is great for stocks. Stocks and bonds do really great in this type of environment because your inflation rate is steady and low. So you can see a lot of 2-3% inflation. You can also see that this period was pretty steady and low outside of the 1980 mark, but we came down below it in 1983 and it was steady and low for a very long period of time. It was even steady and low from 98 to 2008 during that commodity bull market. But inflation never really went ballistic. What we had back in the 1970s, we had ballistic inflation. It was above this trend line for sure. It was far over the trend line. We got to rates up at 13% and even all the way up to 15 or 16% in terms of inflation rate. I am of the kind that thinks that is demographic driven, and some people may or may not debate that. And I think it's the demographic interacting with the housing market with more new loans coming into the system. New loans coming into the system is total bank credit. So, and remember, this was from a very low level before, off, and we came on up in that time frame. So we have this over here. We have the total bank credit GDP. We've got the increase in oil price. And if you notice kind of on the right-hand side, we've got higher inflation rates, very much well linked to oil price. Now, oil price pulled back before the inflation rate did. So I think oil is a transfer mechanism for inflation by the way that they measure it in the consumer price index. Oil is the number one commodity. I call it the master commodity. If it's the number one commodity, it means that it's used in the most products. It's the most versatile. I think it also is used in the most products in terms of volume as well. So it's used everywhere, and the price of oil has an impact on the consumer price index for a variety of reasons. Usually it means it's in an inflationary environment where oil is actually transferring money, total bank credit, in the system into the cost of goods and services. And what they did here in May and June of 2022 is they basically dumped into the market a lot of strategic petroleum reserve oil. And then we had China also go on lockdown with the COVID type stuff. So I think that really tampered down the inflation in the world, because what it did is it brought the number one commodity price lower. Obviously, they did this on purpose. You can also see that total bank credit versus GDP. They were trying to get that total bank credit and get some of that M2 money supply out of this system as well. They also hit and did quantitative tightening. So they kind of did an approach of all things in the system to reduce inflation, in my opinion. And so far, the rate of inflation has come back some. Maybe that is partially successful from what they did. Maybe that's also some of the money just rolling, going through the system, because they did print a lot of that money back in June, kind of like it pumped in the system March, April, May, June of 2020, and it usually sticks around for about 18 months to 2 years, somewhere on that that level, and it's about 2 years before oil started to come back down. So we've got that there, and I've also got another chart here that, well, we can look at the inflation rate. This is the inflation rate. I'm going to take these bottom guys out and just look at it from this perspective. We also have this inflation rate that's been all the way back to the 1915, and we've got these large volatility, boom and bust cycles. We went all the way up and hit the long-term trend line right on the head there. We've pulled on back a little bit. Now, what I'm curious to see is if we break to the upside here. Is that going to happen? I don't know. If it is, we're going to see oil, I think, try to push it higher at some point. With the imbalances of oil and China reopening and the Strategic Petroleum Reserve releases stop releasing, it could push the inflation rate up above this long-term trend line. And maybe we go into a highly inflationary environment. Maybe we don't. Maybe we stay below trend and we just trend sideways at 4, 5, 6% or something like that. But this is also one of the charts I wanted to show you in this. And it looks like we still have our horizontal lines from the other one because these are not supposed to be on this chart. So there's that there. I also have the producer price index in relationship to the consumer price index. So I'm talking a lot about inflation here. The one thing I wanted to talk about here is we've been in this massive downtrend for a very, very long time. It started in 1940s, and we went all the way down to the bottom of 2002. What I think that is that the price of goods and services has materially declined over that time frame. Think of it as efficiency gains in the system. We've also been able to extract more oil, more commodities, ever more efficiently over this time frame. So the price of these things have been declining over time. Your producer price index, the cost of commodities in relationship to the consumer price index, or the increase of prices in the system, have been going down, and it's been great for margins for companies. Think of stock market. So when you get this delta and it's going down, that's great for stocks. This was basically back in 1980, and that's your huge decline all the way to 2001. And that was the peak of the dot-com bubble. There's a reason it peaked at that time. And what happened is we had a large adjustment here coming off the bottom for producer prices going up at a faster pace than the consumer prices. So think about that as margins getting squeezed in the system of regular companies, ones that convert commodities into usable products, Apple, and anything else that's like that. Then we had another kind of pullback here in between. This is more or less driven by that total bank credit that I was showing you over GDP. That this one had an impact because credit was being created at a faster pace than GDP. Now we've got a pullback here. That there was great for, it's a disinflationary environment. The margins were expanding in the companies, and we had a big stock market boom from basically 2009 onward. So we had a nice, good pullback in this ratio where stocks do very well. And then we have another very large move where we hit our head off that resistance area and it pulled back. So this here recently from 2020 onward, we've had producer prices or commodities go up at a faster pace than the consumer price index. That is favorable for commodity companies and precious metals and stuff like that. Hard assets. Now, what's really weird when I look at this chart of this ratio, we have a double bottom here. Bottom one here and bottom two here. And I see this pattern all the time. We get the lead-in pattern, and then you get this nice double bottom W-type pattern. We usually pause around this section right where we're at. We are pausing, and then we're going to see if we can break to the upside. Now, if we break to the upside, what that means for us is we go into an environment where margins are compressing on regular stocks that convert commodities into usable products. Car companies, technology companies that sell goods, physical goods, anything that sells a physical good, I don't think they're going to do as well as commodities, hard assets, and precious metals during this time frame. Now, what's alarming here, a little bit alarming to me at least, is that we're putting in a double bottom and we could break to the upside here, which basically means that we're going into a paradigm that we may have never seen before. And it may be sustaining if this is a true double bottom. So this here, this in the 1970s, this was just a blip in a more or less overall larger downtrend move. Now, there's some things I want to talk about that are particular to this. This here was created partially by a demographic and also peak oil of the United States. And I think that's what created this large move. It was liquidity coming into the system at a faster pace than GDP, and it was a constraint on a commodity, the number one commodity, in the system. But we could grow our oil production worldwide. Now, what this is telling me with this double bottom here is that we could break out and move to the upside for many years, signaling that maybe we have a problem with our number one commodity, oil. Much like the 1970s, but on a larger basing, this is a bottoming type pattern. We could see increased pricing of oil, which then means that the producer price index also goes up. We're also, I think, going to see shortages of commodities or deficits in commodities, where commodity prices are going to go up quite substantially for a period of time. If we can't mine more commodities at ever cheaper prices, then this would make sense that this would go up over time. So we could obviously go up over time here, and this thing would do a double bottom, break out, and then move higher. The part on the right side would basically be signaling that we have resource constraints in the system, and we can't do much on the total bank credit side. And that's where the problem basically lies, is we come to a point where the system must grow. It cannot collapse down on each other. It basically goes bust if it collapses. So you must continually increase the total bank credit or M2 money supply continually for the system to exist and maintain itself. But if you run into commodity constraints where you cannot grow your GDP at the same rate as your M2 money supply, you would get a chart that looks exactly like this, where the producer price index or commodities would continually outpace the consumer price index in an inflationary type of environment. Now, I'm obviously using that scenario. I could obviously be wrong that commodities do not have constraints. Technologies will solve it, and we will develop other alternative energy sources where we've got a lot more energy, and that energy will allow us to extract lower and lower ore grades ad infinitum. I don't believe that, but I think maybe partially it's true, where we could maybe go sideways for a little while before heading higher, which is very well possible. Something that looks like this, and then go higher, whatever it may be. But this to me looks like a double bottom. And you know the reasoning behind it, and at least my reasoning and how I'm interpreting the data. And this here is going to be a completely different world than this here in terms of how it's going to look and feel. This one here is wealthier and wealthier as you decline. This one here is going to be a tougher life. Things are going to get a lot more expensive, and I think that some people are going to have to live with less. It's going to be a little bit harder lifestyle. So that's what I've got for today. I just wanted to go over this, give you guys some more information about the overall big picture view. My investment style and strategies are based off of the big pictures. So when people ask me, where do I think this thing's going to go? I'm going to say, well, I think oil is going to go higher. I think commodities are going to go higher for over the next 5 to 10 years. I don't take months time frame or weeks time frame. I know some people like trading those types of things. I can do it. I don't like to do it. I like to take the big picture view, accumulate assets, and just sit in them. I know some investors, at least a lot of the investors that I've read, Peter Lynch, Warren Buffett, even Jim Rogers and those types. They're kind of buy and hold type investors, and that's kind of where I've learned from. That's kind of how I've got my mindset around. And it took me some years to figure this out. It wasn't just, I came up with it one day and it worked. I've had success doing it. I go around using ratios, buying things when they're cheap. I look at the market conditions, and that's really what we're looking at here in this clip is the market conditions. And I think that we could go into a prolonged inflationary period, or maybe however long, until we hit maybe and develop another energy source or something on the lines of that. But that's what I've got for today, guys. Give me a thumb up if you like the content. Subscribe to the channel if you haven't. And definitely check out the website if you're interested, and use the word discount in the coupon code if you'd like to sign up. And again, we've got a platinum question and answer session Saturday, 7 a.m. Hope to see you there. We'll catch you next time. This is Finding Value.